Good morning. All right, good morning. Hey, fill out the form. Let's do a survey. What you doing today? All right. Let's go. All right, welcome to Forex.Today, the YouTube community of more than 21,000, almost 22,000 foreign exchange traders. Oh, look how small my head is. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Well, because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Hey, I'm going to be in Vegas at the end of the month. Does anyone want to get together for cocktails or a cigar or something like that? I'm doing a keynote speech at the Money Show. Yeah, end of the month at the Paris. The Paris has a great little cigar bar. It's very cool. I do a 2-hour speech on Monday, the 23rd, that last Monday, and then I do they call it a celebrity meet and greet, and then I think the next day, Tuesday, I do another hour speech. So I'll be around. Let me know if you want to get together. Right? Maybe cigars. Maybe we race Ferraris. Maybe we show off our 6-pack abs. I don't know. But you tell me if you're going to be in town. We can make it happen. I like fancy steakhouses. Anyways, let me know. That should be fun. So I have a poll running. Would you please answer the question? What are you trading today? Very risk on, risk off, very risk off. What you doing? Tampa. Yeah, I was just in Ybor City, Johnny. Yeah. Some of Tampa's nice. Some of it, not much of it, but some of it's nice. Tampa. Very cool. So I hope you have great weather, Johnny. Nice and warm. So as you can see here, or I think maybe you can see, I'm doing a spike engine upgrade right now. And so that's doing its thing, downloading millions of data points and calculating them and doing projections and assessing reactions to actual news coming out. Just really neat. Really neat stuff. So we got that going on. Let's get an update on, I guess what I'm saying is, don't freak out. We don't have non-farm payrolls in 1 hour and 30 minutes. Yeah, it's a placeholder. Hang on. But, so we're updating. Don't freak out. So let's get an update on the headlines that have just come out minutes ago. MXN, Banxico's cautious stance, Commerzbank. Irish jobless rate remains stable at 4.7%.
Silver prices slump, reversing short-lived rebound. Gold prices fall. Silver plummets with recovery short-lived. ECB press conference. Lagarde speaks on policy outlook and euro exchange rate.
Lagarde speech. Policy is agile, prepared to do what is necessary.
Pound. Strength expected to pause. TD Securities. ECB press conference. Lagarde comments on policy outlook after holding rates unchanged in February.
Do what's necessary. So if you've been around, you know what she's playing off of Draghi. Remember Mario Draghi? I'll do whatever it takes. I'm surprised she would use that language. That's kind of interesting. But interesting. So the Bank of England and the ECB did nothing as expected. And having looked at the analysis, you should expect not a lot to happen pip-wise. So already looked at the spike radar. Now I've torn it down like none of this should be working right now. It's pretty as heck. It's just not accurate. And so you can see you're like, wait, look at the unemployment rate for Canada 15 times on the, yeah, we're working on it. It's actually doing stuff, right? But what we're doing, one of the things that we're doing is setting up these toggles so that you can have events that are coming up, and with all the analytics, analyzing all the different assets so you know what to trade. The Dow moved more than the NASDAQ, and then pound moved more than Aussie dollar. And it does the beats forecast, meets forecast, misses forecast, and all that kind of stuff, and then plots it. The only thing is that's all mock data. But we have it. I mean, it's working. What we did is destroyed on purpose. I think he said thousands, he meaning Aiden, thousands of old records, and we're repopulating and redoing the analysis with an emphasis of, better organized data. And then once something passes, so like today we watched Bank of England, and a giant pop-out came out like, Bank of England's about to make a decision, and it was so good. It was so good. And then what he did, as soon as it came out, he pulled it off the spike radar because it's passed. You're like, well, it's only 2 minutes old. I still kind of want to look at it and analyze it and think it like. And so what we've been building this morning, and part of this update is having a pass toggle that then brings up the events in the recent history. So you can have stuff that's coming up because they might be an opportunity, they might be a threat. And we organize them based on extreme spike expected, moderate spike, or low vol or whatever. And the reason we post that is because, like, why even post it if it's low vol? Well, first, you should know. The second of all, the priority of the spike radar is on the analytics that we use in our macroeconomic data crunching. So I've prioritized GDP, CPI, interest rates, unemployment rate, trade balance, and then the commitment of traders report, because we can get that data. We can get that data across the board for everything, so we can compare apples to apples. Like the number of jobs added or lost between Australia, Canada, Europe, the United States. Well, the numbers of jobs are not apples to apples because the United States is a heck of a lot bigger than Switzerland, right? So Switzerland added 2 jobs. Canada lost, 4,000. Is that a big deal? So we have to do the unemployment rate, you see. So we prioritize that first and then analyze their impact on the actual market so you know if it's an opportunity or a threat. That's a lot of data. So you guys are risk off, and that seems aligned to today. But over the last 30 days, it's quite risk off. For an overall assessment of daily, weekly, and monthly risk at being 7.2, it's still pretty strong risk off. And then to do that calculation, we look at 3 time frames, weight each time frame, meaning short term is much more significant than longer term because things might be changing. And we look at volatility, Bitcoin, S&P 500, Dow, NASDAQ, gold, the 210 spread, the 2-year yield, the dollar index, junk bonds, the Nikkei, investment grade bonds, the 10-year yield, and of course changes in these yields, and the spread between the 210, and the DAX, weight them all, aggregate them all, and then give you short, medium, and long-term risk assessment, and then just give it a risk score. Cool. That's it. And so, if you said risk off or very risk off, then that's great. If you say risk on, you're probably overly aggressive. You might be right. I just can't prove any of it. Right? And that's the thing. It's not what you know, it's what you can prove. I learned that on training days. Huh? Come on, Hoyt! Oh, man. Any Denzel movie is a learning experience. So anyways, just make sure you're not trying to beat the market. For those that said risk on, make sure you're not trying to outsmart the market, beat the market, move the market. You're probably not big enough and don't have enough money. So what you should do is line up your trading behavior with actual market conditions. So you might be right. I just can't prove if you're right. you're probably not right. But even if you are right and you do throw down those trades and you do make money, you're taking undue risk. Okay? So just be careful. Okay? We can go through the fundamentals. Sure. COT, we've already gone through. The econ radars, it's jobs week. So, by the way, NFP got moved. So NFP isn't actually tomorrow. The United States had yet another government shutdown. So that's pushed to, what is it, the 11th? But we still have the data if you want to eyeball the data. So the question is, our hourly earnings show you inflation. Inflation from higher wages. Unemployment rate tells the Fed whether the economy is cooling off or not. This is a key point of us understanding their likelihood of changing interest rates, right? Monetary policy. So we want to track that. We want to track the trend, but also Aiden is using artificial intelligence to predict the future of non-farm payrolls results. Oh, yeah. Yeah, Abdul, I'm well on my way to that. Well on my way. Okay, today, Abdul, is going to be a killer day, right? Lots of ironing out. Yeah, not a problem. Another way you can try to assess monetary policy is the change in the yield curve, the slope, the change in the spread of the yield curve. Okay? Will tell you like where the money is going. So money is coming out of the long end and going into the short end. Hills bills. And you can see where the yield curve was 30 days ago. And so we're getting a steepening and a rising of the yield curve, which helps you kind of understand where we're going to be in the future of interest rates. And really what you've been seeing over time here is the market taking out some of the cuts that they had priced in. And so we're just kind of getting to steady Freddy. Warsh was a big deal, by the way. That was a big deal. Huge deal. The Fed is going to remain independent. He's a former chair. He's the youngest person to serve. He was against quantitative easing when we were doing it. And then when the Fed kept interest rates at zero for years and years and years and years and years, Warsh was the board on the governor. He wasn't a Fed president. He was higher than that. He was a governor. And the whole time he's like, dude, the Fed's too slow. The Fed's too slow. And then when the Fed left interest rates high, he was still telling people like, dude, you're too slow. You're too slow. So he's not a puppet for Trump to slash and burn. He's actually a good choice. He was screaming when someone needed to be screaming. So I'm very happy with that. And you see, like, if you're scratching your head and going like, why is crypto crashing? Why is gold crashing? When you watch Bloomberg and CNBC, they'll tell you things like, it's short selling by the Chinese, or over leveraged of the Chinese, or it's the Russian central bank. You're like, dude, where do they get this crap? Hola, pardon my French. There's no need to hedge the loss of independence at the Fed if Trump actually picked someone that's good, not just someone that will do Trump's bidding. People were freaking out that the Fed was dead. And all of a sudden, like, oh my God, Warsh is a good choice. The Fed's going to remain independent. Like, that's good. I don't need to hedge. And it's instant. Go back Look at gold, look at silver, look at Bitcoin at the price an hour before the nomination was released. Okay, I think it was 7:30, 8 o'clock in the morning, New York time. And Trump announces, washes the candidate that he's chosen. And you should not be shocked, but you will see that's boom, the catalyst. You don't need the hedges. Hedge what? That risk went away. Good to know, right? Yeah. Yeah. And then you can look over history and say, well, how, is that normal? Is that abnormal? And that's where looking at our seasonality is really important. So here, this is the S&P 500. Did you know that this is normal? The way to read this is down is normal. You say, well, green here. Well, look at the 5-year vol spread, and then look at January, starts high and comes down and keeps falling till the middle of February. There's a bounce in March, another decline near the end of March, and then a buy a dip scenario. So go back a year ago. What did I say in the beginning of January of last year? Be prepared for a significant decline in the stock market and risk assets, somewhere between January 1st and April 1st, and most likely closer to April 1st. And it did that. What was the catalyst? Trump. Remember Liberation Day? He's like, I'm going to tariff everybody by 50%, right? And the market freaked out. Yeah, but once again, that's understandable. Or do we have a catalyst like that in front of us now? No, maybe in November, but no significant crazy catalyst now. So now you can lean back on normality, and you can see the normal, this normal January to February is more down than up, and that there's some stabilization and then maybe another one coming. It doesn't have to happen that way. But this is my year planned out for the S&P 500. Cool. So what works? What works in February? Bitcoin. You're like, Wayne, that's wrong. Well, TRADARS isn't wrong. That's not wrong. That's normal. So what's the abnormal? Well, okay. The news around the Fed pick. Okay. Now, what is normal in the month of February? Silver falls. Strong bearish. And it said that when gold was $100, 110. I mean, silver. It said that. It's like, yeah, okay, silver's 110, bro. But what's normal for silver? It peaks out in January and then drops significantly. 8% is normal. Okay, because we do peak to valley, right? Boom, boom, boom. So anyways, up to down. Yeah, totally normal. Good to know, right? Yeah. Now, does this normality take into account, the Fed news? No, that would be abnormal. Yeah, that would be abnormal. And you can see we're at the bottom of the standard deviation, which is negative 8.95. What? Let me get my drawing tool. Oh, I did the wrong one. Epic. Let me get my EpiPen. This is a key point in your analytical process. Okay. This is projected. And over 20 years of analysis, the most bullish of this period is silver going up to here. The most bearish in this period is here. Now, it's tanked. Yeah, that happened. Okay. Look at silver last year, though. There's a recovery near the end of February and into March. Then a decline. See the decline? You want to look at not just the green bar means up. You want to do relative, where the next bar is up, but a heck of a lot less up. So it's not that it's bearish, but looks like bulls have taken some profit. And then they start building up positions again that can last, all the way to the year, end of the year. Good to know, right? Cool, right? And so, as a trader now, shouldn't you know this? Okay. On average, silver loses 2%. Okay, 2% in February. But on average, it gains 5.49. And if you can find the bottom in February and go through March, because this is important, I added this for a reason. Just because February is down doesn't mean it's down the whole month. So if you can find the valley and take it to a peak, okay, 7.66. Now, is it going to happen? We don't know. But should you know? Should you be ready, willing, and able to get out of bed and do what needs to get done? Yeah. So it's a heavily volatile month. Gold sometimes rises 5, but has risen as much as 4.6, has dropped as much as 9. But when you look it all up, it's a bad month for silver. So whoever was piling onto silver at $110 because it jumped so much, you're chasing price, bro. You're like a dog chasing its own tail. It's a strategy that stinks. Yeah. Anyway, so look, this is easy. Look how easy it is. Well, it's easy to have the data. Yeah, baby, yeah. Hey, do you like charts? You like the charts? I'm going to dump day. I'm going to go out to swing. So all of these are 4-hour charts with a combination of weekly and monthly pivot points. Aiden's bias is 60% fundamental, 40% technical, but technical in a maybe not in the exact. Am I planning to add? Yes, Dan. He's asking, can we add some more assets and seasonality? What would you like in there? One issue is we have to look at every month going back 20 years and then do statistical analytics for every single one of those and then create trends from them. So it's like it's not a small feat. It's not a big deal. But let me know what you need. So what I did, like, for example, I was talking to the crew this morning and we were looking at the spike radar, and it was showing Swedish news and Norwegian news, which is great. I counted them as part of the majors, and it wasn't pulling some of the data for like Norway, and I'm like, oh well, I have to go and get month over month over month for 3 years, and then analyze every chart on 1 minute candles over an hour. So like just that little thing is tens of thousands of data points, and I'm like, should I spend time on this? Do you guys even trade Norway? And people are like, no, thumbs down. Don't worry about it. I'm like, so should I just get rid of it? Get rid of Norway and speed it? And they're like, yeah, just get rid of it. So I did, just like that. Adding them back is a lot more work. But, right? Dan. Known you a long time, Dan. If Dan needs it, it will be done. So let me know what you need under seasonality. Okay. All right. So looking at these pairs, we've done all right. Like earlier in the week. So today is what, Thursday? I think it was on Monday, right? Well, what I'll do is I'm not going to do like every cross pair, but dollar pairs, yen pairs, Swissy pairs sound appropriate. Okay. Yeah. So anyways, at the beginning of the week, it showed euro dollar up, pound dollar down. And like a lot of this was like, we didn't have the congruency. So I said to TRADARS at the time, when you lack congruency along the dollar pairs, it shows you that you should be focused on cross pairs because we lack a macro trend around the reserve currency. And I'm like, but it's really strange. Like, I'm like, that's strange. And so far, it's actually been correct, which is great. So euro dollar set here for up, and pound dollar is set down there, and this is set down, and like, yeah, I got it. I may not like it, but it did all right. It was accurate. And so mixed bags across the stock indices. What we do see is a slowing down of many events. And in some cases, reversal. So like DAX, for example, this whole chart, even though you see how price is up here, where's my drawing? I'll do it in a different color. You see how price is up here? So price was up, Aiden was bearish. And 2155 was up, but Aiden was bearish because remember, 60% of the call is based on fundamentals, not technicals. Okay? It's making lower lows and lower highs, but from a pure technician point of view, Aiden's neutral because he's like, dude, well, like if you had a MACD here, MACD would be up. If you were using moving averages, even looking back to yesterday and the day before, they were still very bullish, but he's like, whoa, 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 whoa. Don't be bullish because we are making lower highs and lower lows, but we also broke below the moving averages. Then the third part of this is it's hard to see because it's so flat. The projection is 100% sideways. So how would you feel about technically up, fundamentally bearish, price action bearish, but projection neutral? Yeah, probably not the best opportunity for trading. And this is on a 4-hour chart. Yeah. So you might say, well, Wayne, I think what's happening here is something like this. And what I would say is I do not disagree with that at all. That'd be great. That would make sense to me. And maybe that's setting up on a daily chart. It just isn't on a 4-hour chart now. So at the very least, you should be prepared for the down. Now, starting the week bearish, Aiden said, you know what? This is our sell zone. Even though price went higher, he stuck with it. So if you got the lower low, lower high, lower low, lower high, okay, using technical analysis, the prediction is down here. That's what it says. So when you look at these pivots, despite the moving averages, he's got it set up as a bearish trade. It's a bearish trade with bullish technicals that have now turned neutral. It's complex. There's a lot of analysis going into this. So at the very least, okay, you got to be careful here. Okay. So there might be a move like this in the next 12, 24 hours, something like that. And that would probably be risk on. So what I would look at if I were me, to summarize, I want to see this turn into something more like this. Let us statistically analyze it and tell you when the trend has become bullish. The trend is sideways. Okay. Now, all these other lines, I remove them from this view because there's just too many lines. But what it's showing you is he's looking for overlaps of weekly and monthly pivot points. Okay, that's what's going on. So you're like, ooh, that's messy. Well, he explains it here. Seasonality, it's a break even, but check this out. COT is down. The quant score is heavily negative. And what does this tell us? Institutional investors last week dumped the DAX. Oh, so down. Good to know, right? Now, you don't see all of this on this view. Do you need to know the COT report from the top of your brain? Do you need to know seasonality at the top of your brain? No. Aiden's doing that for you. We've looked at seasonality. It's not bullish. We've looked at COT. It is bearish. So it's all just done. Do you need to see the weekly and the monthly pivot points and check for overlaps on multiple time frames? No, he's already doing that. That's why you're neutral. Cool. And to do this on every asset on the planet is epically good. Epically good. So remember, we were talking about DAX. Maybe it's setting up on a daily. You can get that here. Okay. And that's what I mean. If it turns this way, then we can head back up. But you should know that this is our annual projected high for the German stock market. Why is that important? Well, first of all, we have it set up long-term bullish. You see that? We're long-term bull. On the 4-hour, we're not bulls. But between now and the end of the year, we are bulls. It's not confusing. It's a different time frame. And so what's our annual projected high? Right there. So this is helpful for those that are bullish on the stock market. Here's your 3-wave correction. And then once we start going here, and this linear projection, let me do it in blue. The linear projection currently looks like this. It's just slightly bullish. But if it steepens, then now you already know your annual target. This is important because if you hit that at a seasonal high, imagine your annual price projection is being hit on a month that is very bullish for DAX, but the next month is not bullish. In fact, it could be bearish. What is it screaming at you? Well, using leading indicators, it's telling you take your money and run. Because yes, maybe it goes up this year, but that would be unusual based on history. Past performance does not predict future results, but it helps you calculate the probability of success or risk. And so if you're looking at an a projected high in price, but also a projected high in time, you should probably know that things are highly likely to change, and that no matter what happens next, it would be smart to book your profit or at least hedge or something. Just know it's there and do something. And that's where VIX comes from, by the way. Okay? That's where VIX comes from, because large institutional investors that have, let's say, $1 billion in the stock market, they own $1 billion of the S&P 500. And you come up to a period of like, it's more likely to go down the next 6 weeks than up. So what are you going to do? Dump the $1 billion and go to cash? That's not how it works. So VIX, which we measure here, let's pull that up. I think I got it here right now. Do I not have VIX on here? I'll add it. We had it on the first iteration. Yeah, we don't have it here. It's important though. So I'll definitely add VIX, but I'll show you.
Euro on US dollar steady as ECB holds rates.
Okay, so like VIX here, up is bad. Up is bad. Up is bad. Okay, VIX has been going up, and the stock market has been coming down. So it helps you analyze like if like when does VIX go up? When investors are concerned or have seen risk increase. They buy options on the S&P 500 that will make money if the S&P 500 falls. So they don't want to get out of their cash position, but they don't want to lose. So they buy options, which are leveraged, 40 to 1. So you don't need a lot of money. You buy some S&P 500 options that make money if the S&P 500 falls. So your option would make money. Your cash position would lose money, and they would offset each other. So VIX only goes up if institutional investors are buying insurance to protect their cash position. So if all these huge investors are suddenly buying VIX, which VIX is up 26, almost 27% in the last 30 days. Dude, seriously, what, you need a slap in the face? People are concerned. So they're buying options on the S&P 500 as insurance against cash losses. It's risk off, bro. And guess what? S&P 500 is very seasonal. So therefore, the VIX is very seasonal. So you can then derive, if you have the data, when VIX is falling, you're probably buying the S&P 500 because people that own it don't feel like they need insurance. There's nothing to worry about. Now, we're talking about people with billions of dollars, teams of hundreds of people, decades of experience, Ivy League education up the yin-yang. And all you need to do, retail traders, is not try to outsmart them, because that sounds like a fool's errand, but just spot what they're doing and go along with it. Let them invest into an entire team of quants. So now you can just look at it and go, oh yeah, risk off, I know what to do. And then realize they also have analysts. What are the analysts doing? They're analyzing all the charts for every pair on multiple time frames, looking for opportunities and threats. that line up or go against their fundamental analysis, which is, again, is now, this is quantitative analysis. This is technical analysis. You combine them together, and all of a sudden, if you're using TRADARS right, you're competing against billion-dollar funds that are doing the exact same thing, but it costs them millions of dollars. It costs you $200 a month. But if you can't see it, you're going to get run over like a freight train, huh? Yeah. Like a freight train. Yeah.
JOLTS job openings decreased to 6.54 million in December.
Ooh. U.S. job openings unexpectedly slumped to 5-year low in December. Fed, cut.
Euro on U.S. dollar steady as ECB holds rates. U.S. labor data sends mixed signals.
United States JOLTS job openings below forecast, 7.2 megahertz in December, actual 6.542 megahertz. JOLTS job openings, 6.542 meter versus 7 its own 200 meters expected. Pound March rate cut likely following Bank of England decision.
Ooh.
ING. Texas anti-ESG law declared unconstitutional by U.S. Judge Jose.
U.S. jobless claims rise more than expected to nearly 2-month high. AI tokens. AWE Network, OLA XBT extend gains as crypto sell-off intensifies.
All right, well, that's a lot of news. All right, so what do we know? JOLTS is a disappointment, and that could put a cut back on the potential for monetary policy. That is a shift in the normal distribution to a left skew, which I've explained 100 million times, so you probably know. So that's very interesting. Also, the Bank of England has leaned on the potential for another cut. Remember, they have high unemployment but high inflation, and they're choosing employment over inflation. So now we just learned two things. The probability of interest rate cuts in the United States and in England have increased. Are you going to play that? Is it in your analysis? So the way to use this page actually is you can just run this as you're going on your charts, and you can just listen to the news as it comes out. You obviously would have been updated like 1, 2, 3, 4, 5, or 6 times that JOLTS came out and that it missed. I think psychologically, to the Fed at least, which is part of like my role here, how would the Fed interpret this? You're like, it's a miss. Okay, is that good? Is it bad? But how would the Fed interpret it? In particular, the voting members is what we care about, right? So, how should I do this? I guess we'd go to fundamentals. We go to jobs radar. And then we go to JOLTS. And you'll see the psychological level of 7 million is a big deal. Okay? So in September, we're at almost 8 million. Then we dropped to 7.4. And now we're way down here at 6.5, 6.4, all of this kind of stuff. What this means are there are less and less and less and less jobs being posted on the internet looking for employees. So that shows a cooling off and well below what we were doing. But the other thing to know, if you go back pre-COVID, that's still a lot of jobs. We're supposed to be at like 3 million, 4 million, 5 million would be a lot of jobs. So the fact that we only have 6.5 million, see, now you know this. You have to put everything into context. So psychologically, the Fed's going to go, oh, okay, JOLTS is a leading indicator for the unemployment rate. So jolts down, unemployment rate up, Fed needs to cut. But then someone else could argue, well, you know what? Freaking out at 6.5 million job openings ain't really the thing to freak out about. Okay? And look at what happens to an economy when you pump it full of $10 trillion. Now remember, the US government added $5 trillion in stimulus, and the Fed added $5 trillion in credit, and you got a smoking hot economy, but extraordinarily unusual. So for it to be cooling off from that, I would say is necessary and even wanted. And you're like, but that's not fair because those people are going to lose their jobs. Well, they could be a Forex trader. Commute all the way to your kitchen table to make a living. Can you, right? Do you remember those days when you spent an hour in the car driving to work? And then an hour in your car driving back from work? That's 40 hours a month. And you have to pay for your car. You have to pay for your car maintenance. You have to pay for fuel just to go to your stupid job. So you lose 40 hours of your life. So that's 500 hours per year of your life wasted listening to the radio, and thousands and thousands and thousands of dollars in expenses. Plus you can get in a car accident and die. Or you could just be a Forex trader, or a crypto trader, or a stock indice trader. I also manage endowments. I love it, man. This is the best thing in the entire world as a career. Yeah. Dude, this is good. Right, chica? You're like, how come he keeps saying dude? So anyways, life is great. Life is good. Life is beautiful. I'm glad that you're in my life. Thank you for the patience and the professionalism that you show me every day. And tomorrow I'm going to be at FX Street. You're right. It was originally announced as non-farm payrolls, but then the government shutdown changed non-farm payrolls to next week. So then tomorrow's webinar, you're probably still going to get the email link as if it's NFP. Don't worry, I know it's not NFP. But the actual webinar has been renamed Off the Charts with Wayne McDonald. So, hey, life is complicated. But trading could be easier. It can be if you're informed. Remember the Harvard motto, Veritas. The truth through knowledge. So I need to bring it down though. But when I got my first degree, Harvard gave me a lamp and welcomed me to the Illuminati. Yeah, true that. Illuminati, illuminated. You know, you can see. You know the truth because you have the data. You know the reality. So we don't have to guess anymore. It doesn't have to be chaos.
AI.
What's the market like right now? Oh, well, there. I just answered it. So you should probably be concerned. Risk off assets. Okay. Again, no longer a guess. You just know. And now you can go through your day. Like in just seconds, you're like, oh, I should be cautious. Yeah. Maybe I'll drop my lot size. Maybe I should be careful on some of these pairs. And now you just learned the Bank of England's likely to cut. This miss on the jolts might. We don't know if it'll make the Fed cut, but it's something they're going to discuss and ask each other, well, if this is a miss, does that mean unemployment's going up? Should we be thinking about a cut in the future? If not soon, later? But at least we know. At least we know, and now you can make informed, intelligent investment decisions. Peace on earth. May the pips be with you. May your profits be above average. And remember, most of these tools I just showed you today are free. I think that's a pretty good deal. Doesn't put you in a sales funnel. Doesn't do anything but unlock all our sentiment tools. It's a ton. It's real value. It's worth a lot of money. And there's no sales pitch, because if you see what I got, you'll stand around the block. Fergie knows this, right? Got the boys lined around the block just to see what I got. So once you log in with nothing but an email, you're going to see what I got, and you'll use it, and maybe you'll even upgrade. As simple as that. There's no sales pitch. If you see what I got, that's it. Drop the mic. Webinar over. Just rocked your world.